Hey, welcome back into the podcast. So today we are talking to you if you are a buyer out there buying a house, and we're going to go over the A to Z's on how to find insurance and get it so that you maximize your protection on your new place. So we have a new face on the podcast. His name is Nick Senseri. How's it going?
Good.
He's with Country Financial. You nervous?
I'm good.
So he's come in, he works for Country Financial. We've been sending him a lot of business, and he's really knowledgeable, so he's going to cover the insurance side. And then, of course, we have Old Reliable Lane Bowling. How's it going?
Good.
Wholesale mortgage. What's going on with rates? 2025, January?
Not much movement so far in January.
Second day of
stable.
Trump, so we're kind of figuring out how that's going to all play out. So.
Yes.
So again, my name is Ken Hanks, team leader of the Hanks Real Estate Team. The goal of our podcast is simple. We're educating you about buying, selling, investing in real estate in Northern Nevada. If you like our videos, subscribe. Please pass this along to someone that could use it and find use for it. So let's get going. So Nick's going to talk about the A to Z's in insurance. We're going to quiz him, talk about what you should be looking for when you're buying your house and once you're in escrow. So Elena, I first want to talk about, so I'm a realtor, I get my buyer in escrow, and then what prompts you, or what in the process prompts them to call Nick and start the insurance process? Because obviously, a lender won't give you a loan unless you have insurance in the property.
Right.
Correct?
That's step one. Is congratulations, you're in escrow. Please start shopping for homeowners insurance.
Right.
We tell our buyers to do that on day one so that they know if there's going to be any delays. And it's also a requirement to have your insurance in place before releasing your closing disclosure. And we try to avoid that delay and get the closing disclosure out right away. We typically recommend Nick. So we ask people to give him a call, or if they have someone else, we say, okay, check with Nick, and option B of their choice as well.
Right. So we usually give them a few choices, just like we do lenders and all of us. So that's when we bring Nick in. So Nick gets the call. You should do this right away. Don't wait, because it can hold up your escrow, and then bad things happen on all in. So Nick, you get the call from our clients. So let's talk about when purchasing a home policy, we're going to consider the following standard coverages. So I'm talking about once you get in it, now you're going to start talking about the meat and potatoes about what's in the policy. So first thing is, what is dwelling coverage? What does that protect?
So the dwelling coverage protects the home itself. So the structure of the home, the cost to rebuild the house.
Okay.
And there's a couple options that we offer when it comes to the coverage of the dwelling. The first one, the cheaper one, is going to be a 20% extended coverage. So we'll just say, for example, we're going to insure your home for $400,000.
Okay.
The 20% extended, so it gives you an extra $80,000 just in case the $400 wasn't quite enough to rebuild the house. So you'd be insured up to $480,000. The better option is the guaranteed replacement option that we have, and that on that we don't put a cap on how much we will pay out. So if we say we can rebuild the house for $400,000, we guarantee you that we can. And if your home burns down to the ground and it costs whatever that cost is what we will pay. So you don't have to worry about being underinsured. So
now, question for you: is that a Country Financial, or are these different policies you can get from any lend or from any insurance company, or is that specific to your company, or do you know?
It's not specific to Country. However, not every insurance company offers it. So we are one of the companies that does offer it. So it's a good option to have.
We go through Country Financial, and we have guaranteed replacement. So in LA fires,
Yeah.
Country Financial doesn't operate down there, so it doesn't impact you. But something like that, hopefully you have guaranteed replacement.
Hopefully, yeah.
So we got dwelling coverage. What about other structures? Because a lot of people have barns, sheds. What are the definition of standalone fences? What are some other examples, and how does that fit into it?
Basically that's any other structure on the property other than the home. Like you said, it could be a shed, a detached garage, fencing, anything that's a detached structure is covered under that other structures.
And that's an additional charge on there, or what does it look like on the policy?
It is additional charge. It's pretty inexpensive depending on what you're insuring. I mean, if you're insuring a big, huge,
utility garage that
Yeah,
has heating, cooling, and all.
That might be a little bit more, but typically the policy comes with usually about 10% of what you have the home insured for.
It's covered with that.
Yeah.
Okay. Elena, what about from the lender side? Do you care about additional structures, or what do you care about as a lender when you get a policy?
If the additional structures are not financed, then no. What we primarily care about is the dwelling or the replacement cost.
Because I come across properties that have a huge barn that's like a finished barn. Is that
Right.
that changes the game for you?
If it's included in the square footage that is permitted, then yes.
Anything else on other structures? No, not much.
Yeah, it's pretty.
It looks like fences or sheds. And that's,
Yeah,
Okay.
that's typically what you would see, unless some of the houses that are more rural, they might have those big detached garages
Okay.
and stuff like that.
So if it's a case by case. If it's something that's unusual, then it's going to cost more money. I'm guessing.
Right. I mean, you might have like a swimming pool or something like that, or but
Okay. So the third one is, Elena doesn't ever want to hear about this, personal property coverage. So the one thing you get in trouble in contracts is talking about personal property that's left behind, and lenders get kind of weird about that. So typically that needs to be negotiated on it as a side deal, or make sure you ask Elena how that looks, right?
Right.
'Cause
Should be described as a fixture in the
fixture.
property.
Okay.
Those curtains are a fixture.
So if you start negotiating like big ticket items, make sure you talk to Elena, because that can cause problems with underwriting, correct?
Yes.
So what are some personal property coverages? What does it protect?
So that pretty much protects all of the personal property, everything that somebody owns, and it doesn't have to be in the house. It could be in storage. You could be traveling overseas. You lose your luggage.
Okay.
Things like that. The homeowner's policy typically comes with 80% of the home value, or what we have the home insured for, and coverage for that. Most people don't usually need that much, so that is one thing that we can adjust to kind of get the price down. Because, I mean, let's be honest, most people don't have $300,000 or $400,000 in personal property.
Right.
So we don't. A lot of times we don't need that much, but
Okay. So that would include like couches, beds, anything that's
Yeah.
not attached, correct?
clothing, pretty much everything that the owner
Needs to live.
owns, and other than, I mean, vehicles are not included in that because
Okay.
those are insured separately. There's a couple exclusions for, gun
Jewelry.
collections, but those are typically insured up to $2,500. The same as jewelry,
Okay.
$2,500. We can insure them for more, but we need to schedule them on
And
the
that's
policy.
an additional coverage we'll talk about. So okay. So personal property. All right. So let's talk about another one on here: loss of use coverage. What is that, and when would that come into play?
So if you had, say, a fire or water damage, or you need a place to stay while we're doing repairs, if the house is uninhabitable, and you need a place to stay, that's going to cover your rents. Could cover also some gas money, food, and things like that.
Is there a cap?
There is whatever amount of coverages that we have on there, and
Okay.
and that is typically, I think it's 20% of what we have the home insured for.
Okay.
Which is-
The question is like, so if it's a complete loss, we're talking like someone has to stay for a long time. Is that covered in there, or how does that work? Or is it still
Yeah, it's
capped?
pretty much, until that money runs out.
Okay.
So that 20% budget is used up, basically.
Have you had any stories that you can tell us about that being used in your experience? Been doing it for 17 years, by the way, so he's no rookie.
Yeah, I mean, I've never had it totally maxed out.
Okay.
But yeah, definitely I've had people with water damage that have had to use it. To be honest with you, I've been in the country for 17 years, and I think I've had maybe 3 homes burned down, maybe.
Okay. Let's
And a
keep
couple of them were rental properties, so they didn't really. I mean, they use so if it's a rental property, then you've got it's the same coverages, but it covers the loss of rent.
So that's why you have to stay around, because we're doing another video after this, only for rental properties. So that's good. Go out and run your coverage there, Nick. Now we're moving into personal liability coverage. So what does that include? So we have another line item.
So that coverage is going to help protect the homeowner from being sued. somebody got hurt on your property or something like that, where the homeowner was negligent. Um, Typically, we have 300 or 500,000. Some clients that are a higher net worth, we might put $1 million coverage there, or maybe even an umbrella to help them. That helps them, prevent them from being sued. That's going to cover their.
Okay, but standards like what? 1 to 300?
Standard is 3 to 500.
Okay, 3 to 500.
That's what I would typically do.
Okay, and then if you want more, you can get. We'll talk about in a second. Additional coverage, umbrellas.
Yeah.
And then what about medical payments and how does that work? Why do you need medical payments? Because most people have medical insurance, so why is that a line item? What is that?
So medical is kind of like don't sue me insurance. If it's something small, if somebody's at your house and I don't know, sprains their ankle, something like that, you don't want to use that liability, that $300,000 in liability. We're just going to say here's $5,000 or $10,000, whatever it is. Don't sue me, kind of thing.
Okay.
And it's for non-household members. So household members cannot use those.
Okay, that's interesting. So that's for someone that's visiting or a guest that gets hurt.
Correct.
Elena, anything out of that coverage or anything of these standards that red flags for a lender? I mean, what does a lender look at? That's why I'm confused at. Are you just making sure that they talk and have insurance?
No.
And how do you make sure because the lender wants to make sure that their assets protected because they're giving a loan for 80% of it. Is there anything specific?
On the lender side, you're primarily looking to make sure that they're not underinsured because you want to protect the asset that you are loaning the money against. Right. So if there's a total loss there, then of course that's going to be an issue if somebody owes more than they have coverage on. So primarily with purchases, it's pretty much safe. Where we run into shortages, where we kind of end up surprising people is usually refinances. Like if their value went up $200,000 and they're taking a cash out refinance, they're likely underinsured. So we're going to say, okay, you got to call Nick and get a little more coverage there.
Okay. Do you get that a lot on refis that people are?
Yeah, and we typically, we basically we're going to double check to make sure they're insured correctly. We'll run an updated cost estimator because the cost estimator that when they originally bought the house, it could be off a little bit.
Yeah.
It'd be old. We do have inflation rider, so it does automatically update our policies. They all automatically update every year according to inflation. But if people make improvements to their houses, things like that, it's definitely a good idea to update the cost estimator from time to time.
Good advice. Now, how does it work, Elena? You buy a house, and we get to the closing table where all the closing costs come in.
Mm-hmm.
People are shocked. They're like, "Oh my gosh, why do I have to pay a whole year of insurance?" Or sometimes it's a whole year plus a few months. How does that work?
First of all, nobody should be shocked at the closing table. Your lender should go over all the costs with you up front in detail. And the way it works with insurance is you've got to pay your annual policy up front, but typically you get to skip a house payment. So let's say that you close escrow in the month of January. You don't have a house payment until March, but your insurance started in January. Your lender that's been paying or that you've been paying within your mortgage, it's only been 10 months by the time you hit that point. So you've got to have 12 months in order to have enough money to pay that bill on your behalf. So you should not be surprised. There will always be the annual policy paid up front, plus sometimes 2 months.
Okay, so then when they get a mortgage payment,
Mm-hmm.
it includes principal and interest,
Mm-hmm.
the insurance,
Mm-hmm.
and then taxes, correct?
Right.
And then the one thing that we get calls about from clients is our insurance has gone up. So my mortgage payment,
Mm-hmm.
I was told that my mortgage payment was the same for 30 years. Why does that change?
If you are short on coverage or if your tax bill goes up.
Okay.
If any adjustment happens within your escrow account, those are the two things you want to look at. Did your insurance change? Did your property taxes change? And sometimes not that you're purposely driving your bill up, but you'll call Nick and say, I need to have a talk. I want to make sure I have proper coverage. Yes, I'm okay with that bill. And then you don't realize the fact that your house payment's going to go up a bit. And sometimes it takes the lender 3-4 months to catch that. So you've got a little arrearage to make up for within your escrow account.
Okay, so how much is insurance? You're working in Reno. does it go up? Like the county is guaranteed because of NRS, it's going to go up 3% your tax bill if it's a primary residence. So they can count on that. This ever-changing world of insurance obviously is going to more and more. But what do you see in your clients on average per year? Does it go up?
It depends. I mean, with the inflation that we've seen over the past 4 or 5 years, that's not something that's normal. I mean, in a normal inflation
Cycle,
time, I would say, I don't know, probably a percent or two of your,
Okay.
it might go up a few dollars a month every year, or
Okay.
something like that. Maybe $2, $3 would be normal. But I mean, I've been in the business for 17 years, and I've talked to people that have been in the business for 40 years, and they said they've never seen anything like what we've gone through with the price of insurance increasing the way we have seen it. So,
Okay.
but
So if you see your mortgage bill go up, it's because of taxes and insurance. So just keep that in mind because some people get caught up in that. But it's usually paid. So how do you get paid then? That's another question I always do. When it breaks out, do you get a check every month or country, or how does it?
Well, it's at the renewals. When the policy renews, it's once a year for home and every 6 months for autos insurance.
So how does that work? Is there? Do you keep the money and then pay them, or who got lender?
Escrow keeps
Escrow.
everybody's money, and then when we close, they
No, but
distribute the funds.
Unlike year two, though.
Oh, there's a escrow account that's held, and it has to be reviewed annually. The feds require
Who
that.
keeps track of that?
Your lender does, but
Okay.
the feds require an annual review of that. And sometimes people have an overage, not likely right now, right?
Right.
So they require that annual review happens so that if there's any excess funds sitting there, you get your check back. In case you had too much money there, of course, if it's short, then they're gonna ask that you make up that difference.
Okay. And whose responsibility is it? Because I get some people who call and say, "Hey, my insurance just called and said I hadn't made my payment. It should be coming out of the balance."
I typically don't see that unless it's a recently closed transaction. Like sometimes the title and escrow company sent the check to the wrong insurance company and they just, didn't cash the check or threw it away or whatever. And then we're getting a call from their insurance agent saying, "Hey, where's the money?" Right?
We're being on the other end of it. We see it quite a bit, almost every day.
Wow.
To be honest with you, loans get sold,
Oh.
and the lender is supposed to update us when they do that, and so that we are mailing the invoice to the correct company. It doesn't happen all the time, so things slip through the cracks. I get it, it's whatever, but it's part of the business and doing what we do. We fix it, but it does cause a little bit of extra little work there because the client's calling, go, why does it not paid? The mortgage company pays it.
Yeah.
Okay, well, it looks like they sold it, but they didn't update us, so it happens, but not a big deal.
So last question I have, and then we'll move on additional coverages, is it's a lender question. Can you get out of paying through escrow your insurance?
No. Once you set it up that way,
But can I at the beginning?
yes. So if you, at the beginning of your transaction, decide you don't want to include your insurance and taxes within your payment, or one or the other, then you don't have to on most loan products. There are some that require it, so that's what you've got to discuss with your loan officer. It's dependent on credit score because it's a risk for the lender.
Right.
So typically if you're a 680 or under, your lender is not going to allow you the option. They want to include it. For everyone else, you do have that option and that choice, and if you don't include it, you just have to be ready to pay those bills and pay them on time, or your lender will be reaching out to you to do that. If not, they will force you to do that.
Do you have people that opt out?
I do.
All right.
A lot.
A lot.
Mhm.
What?
Yes.
I never. Yeah.
Yeah.
That's interesting.
I would say, primarily I would say it's investors.
Right. Because they have their own.
Yeah, got their own system down, and that's fine. Regardless, the bill goes to where it's gonna end up, right?
Okay. So interesting. And they can get out on taxes too.
Yes.
Property taxes.
Yes.
Who knew? That's why we have Elena here. All right, so we're going to move on to the last part of this interview. It's additional coverages. This is a big topic, especially in our area, because we have been known to have earthquakes and floods, fires. So what about flood insurance? What is that? How does it work? let's talk from the lender perspective. If
If
you're in a
it's-
floodplain,
Yeah.
what?
If you're in a flood zone, flood insurance is going to be required. And it's, again, usually found out pretty early on because we're bugging buyers on week one to get in there and get the quote. And then usually insurance agent is the first one to kind of raise the flag. Sometimes listing agent has done the work and found out that it's in a floodplain to begin with. And if so, you can work on your research in regards to how much insurance will cost you in advance of getting your offer accepted. Of course, that's what we recommend. But you do need to plan on having that plan in place, and the biggest thing is the budget to make sure that it works for you.
Because this can be pricey, right?
Yes.
Yeah, it can definitely be pricey, but some of the things, to get it down is maybe taking a higher deductible, kind of get the price down a little bit. But then there's also the people that if you're not in a flood zone and you do want flood
Yeah,
insurance,
yeah.
it's pretty inexpensive. It's not crazy. I mean, it could be $400 a year, which is much cheaper than if you are in a floodplain. It could be $1,500 or $2,000
Right.
a year.
$200 a month, yeah.
Yeah.
And on the lending side of it too, it's really important to check the current flood map, because sometimes the flood zone is touching the corner end of your property. If it's not touching the dwelling, it's actually not required on the lending side, and that can save you a lot of money if you're not worried about your backyard flooding. But if you're worried about the house, definitely look into that.
So from the real estate perspective, the seller has a form they gotta fill out that asks if they're in the floodplain. So, and if your buyer agent's not looking into if the house is in the floodplain before you make an offer, you should probably find another agent. Because it's very easy on the Washington County Assessor to click on a property and it says, and there's different various risks, the higher risk. Now, how does it work? It's not through you, right? It's through the federal government, but do you tie that all together, or how does that work? The flood insurance, is it not even you at all?
I have a couple companies that we use through our brokerage department. But yeah, so we don't really handle the billing and all that stuff for flood insurance. It's a separate company that handles that. Usually I use the Hartford, or there's another one, I can't remember the name of it, but
Okay.
yeah.
Okay, so flood insurance is out there. You should know that well in advance of putting an offer in, because that's going to definitely impact your mortgage. What about earthquake insurance? We talked about this a lot. We talked about offline last time. Well, let's start out from the real estate. Sorry to cut it off. We're in Zone 4 in Reno Sparks, the highest one you can possibly be in. Well, with that being said, we haven't had, Mogul had the 5,000 different earthquakes, small ones, but what is your opinion, or what are your clients doing?
I mean, I'll be honest with you, I don't have a ton of clients that opt for that coverage, the earthquake coverage. It is a little bit pricey, and it also comes with a 10% deductible. I mean, it is something that we can just add on. It's something we can add to the homeowner's policy. But like I said, 10% deductible. If we have your home insured for $500,000, you've got a $50,000 deductible. So, and on top of that, it's not super cheap to add it. So.
Yeah, 10% deductible. Wow. And now that varies company to company, right?
A 10% is pretty standard in the industry.
Okay.
Yeah.
There's no requirements for lenders, right?
No, but I would agree with Nick. Locally here in northern Nevada, not very common. Southern Nevada, almost zero. Not many people are getting it.
Right.
I'd
You
say
gotta-
probably 5% or less of my clients have it.
I always tell my clients this, and you gotta talk to an attorney, but if your house is paid off, you may want to consider it.
Yeah.
But if your house is 90% financed, more than likely, if there's a house and it knocks everyone's house down, you're probably going to lose the house, correct?
Right.
So.
I mean, yeah, it's gonna have to be a catastrophic event for you to hit that deductible. Right?
50,000, you can fix a lot for 50.
Yeah.
So keep that in mind. But you're talking like half the policy amount, or does it vary?
It varies for sure, but yeah, it just depends. Yeah, it could be.
Now, do you actually go look at fault lines to determine the risk? If someone's on a fault line, is that more, or do you do that analysis?
Well, I'm not an actuary, so I'm not exactly sure how they come up with the amounts that we charge. I don't think we have anything like that in place for pricing.
Okay.
But
So it's just
I
that.
could be wrong.
All right. you said you want, you get it. And that's what most people are. It's just not something that's,
Right.
I would say very few people I know have it. So, we already talked about this a little bit. What about valuable items coverage? And I'm talking for high value possession like jewelry, art, gun collection.
Right.
How's that? It's an extra add-on, or how does it work?
Right, so gun collection and jewelry is covered up to standard on the policy. It's $2,500. We can add those items on for whatever they're valued at. We would just need to get an appraisal, and those items typically aren't too expensive to add. If you need to add a wedding ring or whatever it is, gun collection, we can add those on, and it's not too crazy expensive.
But you have to have they gotta take an appraisal. Does the appraisal have to happen every year? Or is it one
No.
time?
Just one time, unless, if you think the value of your jewelry's gone up or something, and you want a reappraisal to get so we can insure it for a higher amount, then yeah, we can do that, but we don't require them to be updated every year.
Okay. We talked about this, but last item we have on this list is replacement cost versus actual cash value. What is the difference and how does that work?
So replacement cost is going to be, the cost to replace your house, what the current cost is to replace it. Actual cash value, which is it's not a very good coverage to have. That's a depreciated value, which we don't really sell any of those policies. Unless it's an older manufactured home and they absolutely can't find any coverage anywhere else. That would probably be the only time I would see an actual cash value policy. But,
Okay. So most of the time you want replacement cost.
right. Because that's, on your older manufactured homes, sometimes that's the only option that we offer.
Okay.
So
It's an older one. Now, do you actually do mobile homes?
we do up to 40 years old. Well, and we have option through our brokerage. We can do.
So it's a sub consultant or a sub agency?
Well, with Country Financial, it's we can do them up to 40 years old as long as they have solid permanent foundation. If not, I have a couple companies through our brokerage that we insure them through.
Okay. So it has to have a foundation for you to look at it then, otherwise. Anything else? That was a good discussion.
Very helpful.
Nothing.
I think you covered it.
Okay. So if you have any questions, let's give numbers, companies, so they can contact you.
If you need any loan questions, 775-825-1600.
Insurance questions, 775-823-3951.
Country Financial, and you don't mind the information. If you have any questions, leave it in the comments. We're doing this video, and it was one of our top videos 3 years ago. So get a lot of questions or direct message us, and we can send you right to Nick, and you have his number. Otherwise, hope everyone's January's going well, and you're keeping those New Year's resolutions. And we look forward to talking in the next video. Take care.